What's going on, guys? Mike here, and today I want to talk to you about why I chose to go the DIY investing path compared to staying with the traditional banks and doing mutual funds. Now, this is just, again, this is what works for me. This, again, doesn't mean it's going to be the best scenario for you guys, but I really wanted to just highlight some of the key things that when I found out, it made me want to make this change, and maybe it'll have the same effect for you guys. So before we get started, make sure you like and subscribe to this video, and let's get started. So one of the things I just really want to start out with is just kind of highlighting an RBC fund that is what I used to be invested in. And this particular fund was one that I had gotten through like just a group, at work, RSP investment. And, it sounded fine to me at the time, right? It's a diversified portfolio, it's balanced, it has 40% bonds, the rest is equities, and it's, globally diversified, which is great. Now, this is kind of what I was presented when I first had to choose the fund and and kind of get started, right? So everything sounded great. There was no really big red flags that I had, noticed. And again, I wasn't very financial literate at that time. But yeah, so the crazy thing is though is what ended up happening is I ended up getting a statement, and it said my fees were $203. And I was like, yep, that sounds about right. That's kind of what I'd expect. And then on this particular one, it was about a $20,000 balance. So, that would work out to be about 1%, right? Now, one of the things I came across a kind of a peer, and he had mentioned, he's like, well, you realize that's not all the fees that you pay. And I was like, well, what do you mean? Because like this is just one portfolio that I have. I actually have others as well. And he's like, yeah, that's typically only about half of what you're actually paying. So I did some of my own research and kind of found out, okay, well, I'm paying 1%. What else am I paying? So when you actually go and you look at these funds, they actually have highlighted right here these management expense ratios, which they refer to as the MER. And on this particular one, it's a 1.95%. Now, they also do have, I think, some trading commissions as well, which then added up to a total of 1.99. Now, this one isn't the highest I've seen. I've seen some that are even upwards of 2.5%, which is just unreal. I just can't imagine having to pay that amount of fees. Now, that $203 really, it doesn't seem like a whole lot, right? Well, when in reality though, I'm actually paying double. So over all of the portfolios that I had through RSPs, they were all around the same kind of balance. So I was actually paying double than what I actually thought I had been paying. So just kind of looking at a spreadsheet here, I just kind of want to highlight, okay, so 20,000 on the 1% here. That's where it lines up around that $203 I had showed you in that last screenshot. But in all reality, I was actually paying $390. Now, again, it doesn't seem like a whole lot, but one thing that kind of bothered me was that it just wasn't transparent enough, right? Like on the statement itself, it wasn't telling me that I was actually paying $390. So, I started doing the math, and it's like, okay, well, what happens if I had $50,000 in this fund? It's okay, well, I'm actually paying $975 a year. Or if I had $100,000, I'm paying almost $2,000 a year, or even $500,000. So by the time I'm getting closer to my retirement years, this is kind of where I would assume that this fund will be north of, right? And it's like, well, anything over $500,000, I'm actually looking at over $10,000 a year. That's almost $1,000 a month that I'm paying in fees, and it just really kind of got me thinking, right? And you'll see here I have on the section right here is DIY with ETFs. So again, when we're looking at an ETF-based investment style, that can still be through managed, which I'll go over here in a little bit. But you obviously will save even more fees if you go ETF doing yourself. So I was kind of going back to this whole RBC thing here, and I was looking at it, and it's like, okay, well, when I'm looking, there's ETFs that are out there that I can easily pick that are relatively close to these like asset allocations. So I was like, okay, so I'm basically just paying somebody to push a button for me and buy this mutual fund. Well, I can do that, right? And an example would be, I'm not actually in this one, but this is like an iShares ETF, exbell, which I'm pretty sure is the same allocation where it's 40% bonds and 60% equities. Maybe we can just confirm that here real quick. But so when I started looking into that, I was like, okay, well, what is the fees on this particular investment, right? So when you look at this one, the MER is right there, 0.2%. So if you were to, and this is basically a very equivalent to what the RBC fund was at. Sorry, I'm not necessarily prepared to necessarily show this, but exposure breakdowns. Here we go. So equity 60%, fixed income is 40%, just like the RBC fund is. And if you actually drill down to this, the equities, it's in Apple, it's in Microsoft, it's in Tesla, just like the RBC fund is. If you actually look at these guys and you go into their top holdings, again, I actually have to go maybe a little bit. Oh, here we go, top 10, right? So Microsoft, Apple, Royal Bank, this is an XBAL as well. TD Canada Trust, that's also in that same ETF. Enbridge, in that same ETF. And so when I was looking at this, I was like, okay, so I have the choice. I can push the buy button and pay 0.2%, or I can have RBC push the buy button and I pay almost 2%, right? So the other thing is that like typically in that 2%, you should be getting some sort of financial advice, on maybe a quarterly basis or at least, once a year, right? But that wasn't really happening. It was more or less like, put your money in this fund and hopefully it does good. And I'm paying 2% for it. So again, looking at that, it just kind of made me concerned. I was like, well, what value am I getting out of that, right? So I went down the path of investigating DIY investing, right? So I use Wealthsimple, which is a free commission-based trading platform that is widely used in Canada. And so again, looking at the spreadsheet, I was like, okay, well, I can easily do ETFs and push the buy button and save almost 2%. Because essentially what's happening is when January 1st happens, if you're in a mutual fund that's paying 2% of fees, you're technically starting at -0, right? So you actually have to get a 2% return just to keep your money from what you would have started at the start of the year, which again, I didn't really care for. So when I started going down the DIY investing, I was like, okay, well, let's just look at this portfolio and let's build something, right? So one of the things that I did kind of base my initial building of a portfolio was, one, I didn't necessarily want as many bond allocations, so I did trim that down. In my RSP on this channel, I only have 10% bonds, so the portfolios aren't necessarily identical. But the cool thing that you can kind of look at is this gets updated every month. So this last update was February 28th, which is right here, as of February 28th, 2023. The year to date is 2.8% of a return. Okay, so sounds about right. If I actually look at my portfolio tracker that I have in my Excel sheet here, you'll actually see under my RSP, I have just this year, again ending at February 28th, I'm at 4.2%, which is kind of funny. I do have less bonds, but I'm in the same investments. I have an ETF that has Apple and Tesla and Microsoft and Enbridge and all those companies that would have been in that mutual fund, right? So you can kind of see what I'm saying, where you can just save the MER and you're going to come out on top most likely, right? One of the things I did use to kind of build what I was originally wanting, and hopefully it saved my settings here. I must have let it sit idle too long. Yeah, it's still here. So I ended up going into an all equity global ETF. So this is my primary. You can see it's 70%. And then I do really like being invested in Canada. So this one, again, the VDY and XEQT do have a lot of the same holdings, but say for example, TD Canada Trust is like maybe 1% of this overall ETF because it has 9,500 different stocks in it. This one though, I think is around 40 stocks, and of course, like TD Canada Trust is more like 7%. So together it brings my TD Canada Trust allocation up, and among other things as well. So again, you can see my VDY allocation is 15%. I do like being invested in real estate, so I do have a REIT in here at 5%, so that's an individual stock. And I also have my bond allocation, ZAG, at 10%. So one of the cool things that I did to kind of look this over once I was using this site here to build a portfolio, I was always kind of comparing, okay, so this year, the RBC Fund is at 2.8%. Well, what is this one at, right? So if you go down here, year to date, 4.67%. You're seeing a trend here, right? So another thing is that you can go back to the portfolio or the RBC fund here, and you can see last year it was negative 12.5%. Worst year was negative 9.07%. So again, that 2% difference, right? So again, it's not always going to be like that. Sometimes if we're like, say, in an interest declining environment where bonds are actually going to just outperform equities, which obviously don't last very long, but it does happen in those particular times, which we're probably going to end up here in the near future. The RBC fund will probably do better, right? Because of the higher bond allocation. But I am in my 30s and I don't necessarily want 40% bonds. I feel like that's too conservative at my age, right? So that's kind of how I got onto that. And ever since kind of moving into the DIY investing, I've really fallen in love with following these trends and comparing and using the benchmarks to kind of see how things are doing, right? So my goal is not necessarily to beat the market, though. I'm happy to just ride the indexes and save on the MER, right? So, because in theory, if the indexes are going to do 10% that year, most likely the RBC fund is only going to do 8 because it has the 2% cost, right? So, and for me, hopefully I will be near that 10% because I'm only paying 0.2% on my MERs with the DIY. Now, like I said, a lot of the traditional banks, they will charge close to that 2% MER, but you do have other options, which you'll see online people refer to as like Robo Investing. So Wealthsimple also does have that, which is the Wealthsimple Trade platform. And I actually do use that for my RESP for my son. And I'm pretty sure, I don't actually have the numbers in front of me here, but they work out to be, I think, about 0.6% or like 0.7%. So again, not as bad as paying 2%, but it's still not as good if you're paying or you're pushing the buy button yourself. So like I said, I wanted to share this information with you guys. I feel it's really important to know, and these things aren't necessarily taught in school. And people that don't know this, by the time they get to their 60s, if you're paying that, close to $10,000 a year, and you're in a fund that's very similar to one that would have been 0.2%, your actual end result of your portfolio would have been substantially larger than if you had, situations where you were paying that $10,000 a year. Now, don't get me wrong though, there is a place and a time for these mutual funds and going through advisors like this, because when you are doing it on your own, you really need to be disciplined to make sure that you're not putting your emotions into it, because you're seeing this, like say the ETF go down. Well, is that going to make you feel like you need to sell it? Because if it is, then you probably shouldn't do it, right? This is where it actually would be in your better interest to just pay the 2% and set and forget and just don't see it. Now, if you do want to save that 2%, but you also just kind of want to do a set and forget, you can still do it with Wealthsimple. They do have, you can have your automatic transfers of money going from your bank account directly into the online platform, and you can set it up so that it actually does automatic purchases to the ETF. So it's like it's kind of like that hybrid. It's kind of like it's the trade platform where you are actually asking Wealthsimple to manage it for you. Now, what this is going to do though is you're going to tell it to do it, and it's just going to automatically purchase the one that you're telling it to. Whereas on Wealthsimple Trade, they would be picking the funds. You would be selecting, I want to be very aggressive, or I want to be conservative, or I want to be like just fixed income. Well, again, it's just like a sliding bar. If I can, I'll show it in a photo here. But yeah, if you did it on Wealthsimple stocks, sorry, I might have been actually getting the name wrong. I think it's Wealthsimple Trade is the one that's the self DIY, and it's Wealthsimple Invest, which is the managed portfolio. So I apologize if I've been saying it wrong. But yeah, so I'll try to show some photos here of like the difference between the managed and the non-managed platforms with Wealthsimple. And if you guys have any questions, definitely be sure to leave some comments below. I would be more than happy to answer anything for you. And again, if this strikes, some sort of thought in your mind, definitely reach out to your financial advisor, talk to them, and get them to go through this whole thing with you, because technically you have the right to know exactly what you're paying. And, if you want to make a change, all to you, all the power to you. And if you're happy where you are, then you know what, if you're investing, you're already ahead of the game. So thanks for watching, and I look forward to seeing you in the next one.